Thank everyone for joining. Today's lecture will be about ending world hunger with insurance and blockchain. A big claim, I know, right? Big claim. What are the big two claims? We're going to cure hunger and we're going to cure cancer. Now, I'm only going for half, so I think that's reasonable. But yes, so we have a lot to cover, so I'm going to get straight into it. So first of all, who does this presentation apply to? Who's kind of going to be interested in it? We're looking at humanitarians, technologists, behavioral economists, automation researchers, and probably more people. But these are some of the people that came to mind who I think would be especially interested in the topics covered here, especially as we get into some of the later slides and the future lectures. I think they will be some relevance to those people. So let's start. So we will be covering insurance and blockchain. So let's start with the insurance side of things. You've probably come into contact with it, but on a strictly sort of need-to-know basis. It might have been a car insurance policy, and you might have been charged for that more than your parents. So you're thinking, oh, that sucks. I'm young, my parents are older. I'm charged 2, 3, 4 times more than they are. I hate that. And I have less money than they do. Why am I getting charged more? You might have got travel insurance for a trip. You might have heard horror stories of people having horrible life events and an insurance company trying to delay and weasel out of their end of the bargain. Whenever insurance is discussed, this kind of tends to be the topic, is fighting the man. They're not paying their side of the bargain. And so insurance, we need it when we have bad things happening in our lives. And so most of the time we're either dealing with a horrible life event, like a car crash or an illness, or and even if we come out of that okay, quite often we're dealing with a company that is very resistant to paying us. And so a lot of the topics around insurance are very emotionally charged, because when people deal with insurance companies, they often care about them most when they are the most emotional because something bad has happened to them. So most people don't really like to think about insurance too much, unless you live in Florida, where apparently people love talking about insurance because they have so many natural weather events over there that wipe people out. So if you live in a place where a lot of bad things happen often, then sometimes insurance can be a dinner table kind of conversation. But usually in the best case scenario, we feel like we wasted money on something we never even needed to begin with. And so usually the best thing we get is a bit of peace of mind. So I guess I'll stop rambling and start with clarifying. So insurance on a basic level, most of us probably already know this. You're paying for coverage for something bad that doesn't happen to everyone, but it does happen to some people. And it happens to the very unlucky people, and those could be you or me. And the insurance company makes money because there's plenty of people who never need to make a claim because everything goes okay. Travel insurance is a great example of this. Most people who get travel insurance, they go on their trip, they have a great time, they come back, it all goes without a hitch. But there's a small percentage of people who have a freak accident, they get caught in some terrorism event, they have a string of extremely unlucky events, and before they know it, they've had some life-changing moments out there, and they are in hospital, racking up bills, and they hope that their insurance company is going to come through for them and actually pay their side of the bargain. And if something bad does happen, if you are in the hospital, you or someone you know will file a claim with that insurance company in the hopes that they will willingly honor their end of the deal. But as we'll discuss, there's many cases where they don't do that. And this is where it becomes kind of a nuisance and a bit of a minefield of small print. And not many people get outside of that. But when we get outside of that and we look at maybe a bit of a bigger picture, what is the history behind insurance? Why is it important? It's something we take for granted. This is where we get some very interesting stories. So I have a little video to play. If it can be loaded up, it is the Lloyd's of London video.
A coffee house in Tower Street.
Good morning, Sir Joseph. Very nice to see you.
Good morning to you. I brought my young nephew here, Tom Grove, up from the country to see your shop.
Good morning, Mr. Grove. How are you doing, Mr. Lloyd?
Lloyd's Coffee House, a place where mariners, merchants and moneyed men came to enjoy the strange new beverage.
Ah, the coffee.
Here, Edward Lloyd had the foresight to provide not only coffee, but also a service which was useful to his particular kind of customer.
Listen, Tom, the kidney's going to make an announcement.
Gentlemen, Dolphin of and for Bristol arrived here from Nevis. The latter was taken by a French privateer on the 23rd instant, but was retaken in 6 hours after by Captain Jumper in the Weymouth frigate.
Ah, splendid. That's wonderful news. Very reassuring.
Very reassuring to Mr. Lloyd's customers. For this was becoming known as the place where insurance could be arranged on vessels and their cargoes. The procedure was simple. A broker seeking insurance for a vessel went round the coffee house, inviting men known as underwriters to accept fractions of the risk in exchange for corresponding fractions of the premium.
London to China and back. How much to finish? 100 guineas, sir. I'll write you 100 guineas. Thank you very much.
Of Robinson, Harris.
This is the room, and it is never called anything else but the room. Here the underwriting goes on as it did in the coffee house of 300 years ago. The boxes where the underwriters work are still obviously patterned on the tables and benches of the original coffee house. Modern Lloyd's is two things, a corporation and a competitive market. The corporation does not itself do insurance business. As in the coffee house days, it is the individual underwriters who do that.
75,000.
Sit down, Betty.
Thanks, sir. Yes, they'll go ahead lot, but pretty sound, I think.
Lazy, Forrest, John Stewart, Mortimer, Lambwell.
Oh, I see I've got two lines on this risk. One on the main property, one loss of profits. The leading underwriter. Now, McKinley. Got a good line, £15,000. I'll write you £5,000.
And where is it being processed?
It's being processed in the States.
So that means that the film will be flown back the daily takes, I take it, to America as soon as possible.
Quite right, sir.
And how much is the cover for?
$500,000.
I've 10 mares and fillies, 2 stallions, coming from America via this country to Australia.
Any idea how many vehicles are?
15 on
15
schedule now, yes.
I see there's no answer to long-distance haulage.
No, it's predominantly local haulage.
Basically, the procedure is the same as it was in the coffee house. The broker's slip sets out, in abbreviated form, the risk to be covered. And when an underwriter writes a line, he is indicating what part of the total risk he's prepared to cover in exchange for the equivalent part of the total premium. The rate of premium is agreed between the broker and the first underwriter who writes a line. So the broker looks for a leader whose assessment of the rate other underwriters will accept.
So this Norwegian fleet has shown you a pretty good profit.
Well, I think for your account, the figures are very good.
Well,
They are in kroner, are they not?
they are. They're all in Norwegian kroner. And I think with this result, you ought to give me a little...
In the center of the marine floor of the room is the loss book. Every vessel that is a total loss or likely to become one is entered here. The loss book has changed little since it was started in 1774, and entries are still made with a quill pen. Mr. Johnson can remember many historic losses since he first came to Lloyd's as a boy.
Lashed by angry seas and a wind of hurricane force, the freighter Flying Enterprise battles for her life off the coast of Cornwall. The cargo of pig iron and coffee is thought to have broken loose, causing the vessel to list dangerously. Her captain is still aboard, hoping some miracle will save the ship.
And non-marine losses, like the tragic end of the Hindenburg.
Famous airships, the Hindenburg. On a routine scheduled flight from Germany to New York, carrying passengers and a full crew, the airship suddenly becomes a holocaust. Heedless of the danger from burning gases, brave men rush into the wreckage to help the injured, but others beyond help perish in the flames. Many die in the Hindenburg's ashes.
Or the spectacular collapse of the Tacoma Bridge.
Bring about the collapse of one of the world's biggest suspension bridges. A 35-mile-an-hour wind is blowing, enough to set up a rhythmic swinging of the bridge, which increases alarmingly. Road and suspension cables give way to plunge into the raging waters below. The only casualty, a car stalled on the bridge.
A sixth sense, whose other name is experience, tells a Lloyd's underwriter what are the chances of success or failure, of achievement or disaster, with all the intermediate grades of minor loss, for every risk he is asked to handle. Lloyd's eyes and ears are the Lloyd's agents scattered round the world. A typical Lloyd's agent is normally, like this, a well-known local firm. Basically, the function of a Lloyd's agent is to be a source of shipping intelligence for Lloyd's of London. But they have other functions too. For example, a cargo arrives damaged, and there is likely to be a claim on underwriters. Lloyd's agent for the port is called in to survey the damage. His survey is expected to be, and is, impartial, and is respected by all sides. Here, 24 hours a day and 7 days a week, news arrives from Lloyd's agents, ship owners, and other sources all over the globe.
Checked on the flood situation, and I think it's pretty slight.
How much to finish?
25,000.
I'll write you 25.
Jolly good.
So, pretty interesting video. How many knew here that it started in a coffee house? Or at least that's where it really got going. I mean, we've had some history of it before that. Merchants giving out insurance slips, things like that. But Lloyd's of London and the maritime industry was where it really became an industry. It became a recognizable, more formalized practice, and it really was the genesis of what became the kind of insurance that we know and probably don't love today. But the core idea has always worked basically the same. So even if we are working with modern things, a lot more travel, We've got home insurance, car insurance, medical, and we're insuring our devices. We've got pet insurance. So we've got lots of different types of insurance. And some of these are very new, but the core idea behind insurance remains the same, which is that the person doing the underwriting, who is committing money to the policy, is usually not doing it in full, in 100%, and they are betting on the fact that they will write many policies, and more policies than not will go without a hitch. And so they get to take those premiums that they've been paid and pocket them as profit, and the costs they have to pay out are only when claims are made and claims are verified. So that's where we get into the kind of back and forth game where insurance companies don't really want to pay your claims. They want to try and get out of it so that they can keep more profit for themselves. And it makes sense they would want to do this. So it's a very, very much a profit incentive for them to not pay out. And they do a lot of things, as we'll get into later, to try and avoid taking on certain customers who will be more expensive than others. So this gets into what we are really going to define this part of insurance as, and the way you really need to kind of think about insurance is it's a knowledge game. And underwriters have to use as much relevant information as they can, as well as less seemingly relevant information, so that they can make informed decisions on what they charge and who to go into business with. And so even after insurance companies have found out all that they legally can, they often still can't distinguish the people who are sick from the people who are healthy, and the people who are careful from the people who are reckless. So there is what would be called an asymmetry of information. And this is called adverse selection. So it's a market that functions a little bit differently than regular markets. So here's an interesting case study. Joseph Stiglitz. He had an interesting idea on how you could dissuade customers from buying health insurance who were not necessarily the kinds of customers that you want.
Understanding the motivation behind these business practices is also essential to understanding what kinds of constraints governments can or should place on businesses in their efforts to make selection markets work better, a topic we'll turn to in Part 3 of the book. Getting customers to reveal who they really are. An urban legend that is famous among insurance aficionados, and surely no one else, is that of the health insurance company that deliberately chooses to place its sales office on the 5th floor of a walk-up building, that is, a building with no elevator. The first, and as far as we can tell, only, written record of the fabled walk-up insurance office is the 2001 Nobel Prize address by the economist Joseph Stiglitz, who won that prize, along with George Akerlof, whom we've met already in Chapter 1, and Michael Spence, whom we haven't, in large part for his work on adverse selection in insurance markets. As Stiglitz explained it in his Nobel lecture, the 5 flights of stairs would be a good way for insurers to deter the really sick from becoming their customers. While presumably most people would prefer not to trudge up the stairs to apply for insurance or to discuss a claim, it would be particularly unappealing to prospective customers who were sick or lazy. Remember, this was 2001, back in the day before much could be done online. Stiglitz observed that a wily insurance executive would realize that by locating the office on the 5th floor of a walk-up building, only those with a strong heart would apply. The company might even be willing to pay extra for the privilege of renting this inconvenient locale precisely because of its benefit in screening out undesirable customers. Stiglitz also noted that a truly astute insurance CEO would recognize the trade-off between locating high enough to keep away undesirables, but not so high as to discourage too many others. The 2nd floor probably wouldn't be enough, but the 10th would surely be overkill. Stiglitz's example is surely apocryphal, not to mention now ineffective in the world of online insurance purchases. But something that closely approximates this made-up example does exist and is in fact quite common in the real world of health insurance offerings. Think of stair climbing and insurance as offered as a bundle. You're buying insurance, but it comes with a free side of stair climbing. Why not instead offer insurance that's bundled with something that customers see as a free benefit rather than an extra cost to be endured? One that might be appreciated by all, but particularly by the low-cost customer you're trying to attract. This is why some health insurers offer to throw in free or subsidized gym membership along with your health insurance policy. Making a product that customers hate. Free gym memberships, whatever their ultimate purpose, are a nice perk. Many of the ways insurance companies try to make sure they get the right customers are less appealing. Indeed, Stiglitz's apocryphal health insurance company, strategically located on the 5th floor of a walk-up building, captures a crucial feature of many of the real-life examples we discuss in the rest of this chapter. In order to keep away high-cost or riskier customers, an insurance company often has to make its offerings worse for everyone. Not only for the high-cost people it is trying to avoid, but also for the low-cost customers whom it would like to attract. We emphasized in Chapter 1 that one key problem with adverse selection is that low-cost individuals who would still benefit from having insurance are unable to buy it at a price that reflects their risk, and hence their cost to the insurer. Now, we're going to highlight another critical way in which selection interferes with markets doing the job of providing customers with quality products at a decent price. Those who do get insurance may be buying something that's twisted and distorted in all kinds of ways that make it less desirable. In the apocryphal 5th floor walk-up example, stair climbing is unappealing to almost everyone. After all, most people take the elevator or escalator to the gym, even if they're headed there to make use of its stair climbing machines. But the insurer still finds it worthwhile to damage its product in this way because the stairs are particularly tough on people with chronic health problems.
So, what is probably apparent to you, other than it being quite an ingenious tactic, is the core truth that insurance companies, and I'm really trying to drive this home here, insurance companies aim to turn a profit. This means they want to pay out the least amount of claims possible, and this means they actually want to insure the people who desperately need insurance right now the least. Those are the most expensive, most time-consuming, most undesirable customers. This has nothing to do with morality. This has nothing to do with the fact of whether they should do this. This is a matter of business. Cold, hard money. Those customers lose it. So be aware in the insurance world of a kind of cat and mouse game when it comes to this sort of structure of insurance coverage. So as we move forward, and so to kind of recap, insurance markets usually work a bit differently than markets for most other goods and services. And I think this is becoming, as we move forward, very clear that what we're looking at is adverse selection. So I like the definition 2 here, the process by which the price and quantity of goods or services in a given market is altered due to one party having information that the other party cannot have at a reasonable cost. So when we think about things like stair climbing, we know that of all the people that would apply to us, if we're a health insurance company, they're all going to say to us, my heart is great. Why? Because they don't want to be turned away. So customers who are desperate, customers who are just looking for a better deal, they will lie. And they will cost you a lot of money and maybe even destroy your entire business if you take too many of them on. Then you won't be able to help anyone or turn a profit. So when we play these games, we can of course blame the insurance company, but we also have to remember that the customers lie. And because of this is why insurance companies lay out so many questions on forms. This is why they come up with theories like placing the office on the 5th floor. They want to make it as difficult as possible for you to hoodwink them. And they want to add as many stipulations as possible so that if they find out that you have lied, they can invalidate the policy. So let's move on to a bit of a working example here. So if we turn the problem into numbers a bit more, it's not just a supply and demand issue. It's not just the quantity of buying or selling. Insurance must care about the qualitative nature of who is buying or selling. This isn't just like selling a product where any customer who doesn't return the item is a good customer. Brokers often write policies that act as long-term relationships with their customers. So as you can see, there's no point in this case example of pricing above 80. We're placing 80 as the bar here. There's no people who want to buy at $80. So those who need insurance the most, who are the poorest, would be the only ones who would be willing to pay such a high price. The people who basically, in the case of health insurance, would have almost 100% guarantee of needing to make a claim. They're not really buying insurance. They're trying to buy a really, really high interest savings account. And so offering at $80 will attract mostly customers that are sick. So the book hypothesizes that we just listened to that even setting the insurance at $70 will not solve this problem because it will attract healthy customers. But the losses from the poor customers will greatly affect the profits from the healthy ones. And so we get into an issue where if you're healthy, responsible, and you have things in order, you're going to look at a $70, $80 high end, in this example, cost for an insurance policy. You're going to think, I don't need to pay that. I'm not going to pay that. And so the more people that actually want to apply for insurance tend to be the people that are costly to insurance companies. And this is so pervasive that it affects the industry as a whole. And one of the biggest ethical problems that we face is the fact that mandating people to purchase insurance actually works really well, because we make sure that the healthy are mixed in with the unhealthy, and it brings the total cost down for everyone. But of course, that's not an ideal solution to force people to do things. Anyway, if you are interested in more on this stuff comes from the book Risky Business: Why Insurance Markets Fail and What to Do About It. Excellent read. Now, moving on, I want to talk about charity a bit. So if the government was to step in, you may ask, what if they provide a subsidy? What if they use taxpayer money and they shove it into these policies and they say, here's a load of money and we want you to cover as many people as possible, or at least be less aggressive in your selection criteria than your competition. And we will give you money so that you will take on people who are more like problem customers. But the problem is that the subsidy is usually provided to the people who are sick. That's what makes sense. If you were a politician, it would not be very popular for you to go around saying that we need to completely ignore the sick, the injured, the dying, and we need to instead focus all of our insurance efforts on the healthy, the people who don't need this coverage right now, and who may indeed never need it. That would be extremely politically unpopular. It would seem to defy all laws of common sense, and it would make people very angry, and they would probably feel like it's a game played by the elites of society to keep the little man down once again. But the truth is, that would be the best allocation of funds, because all that giving it to the people most in trouble would do is push up the prices. Because remember, we're trying to make a pool of money that never needs to get claimed. An insurance policy with 1,000 people in it and 0 claims is the best, cheapest, and most effective insurance policy you could possibly think of. So if we have an insurance policy that's full of 700 people who all need to claim, it's not profitable. The prices just have to keep going up. And you start getting into kind of breadline economics at that point. So if you give rewards to the healthy, then more healthy people will be encouraged to join the pool, which will create a positive feedback loop where the ratio of healthy people compared to unhealthy people will actually end up positively impacting those who are sick, because it pushes the price down and down and down, and they will become overall less sick as a population if the resources have been given to them initially. Is this making sense to everyone? So if we give insurance policies to the healthiest people, this pushes the price down. This makes the healthcare more affordable for everyone. If it's full of people who need to make claims, indeed if it's full of people with pre-existing conditions even that are expensive, this pushes the price up for everyone. And when the price goes up for everyone, people think, oh, I'm healthy. I'm looking at the amount I'm going to have to pay. This is a really large amount of money. I'm just going to say no. I'm young. I live a healthy lifestyle. I don't smoke. I don't drink. I don't do reckless behavior. Whatever the rationale may be, the healthiest people, the people you most want to build up your policy, the people that go to the gym on a regular basis, they're not going to join. It's going to attract the people who are the sickest and the most expensive. So you're either looking at a downward spiral where the price keeps going up because the amount of people that need coverage coming into the policy are the most desperate. And so as the price goes up more and more, it attracts only the most desperate, who again are just looking for a way out of their financial situation. It's hard to blame them. They're working with the cards they've been dealt. But what that does to the insurance policy as a whole is it makes it more and more and more expensive. And this creates a very negative feedback loop where it continues to get more expensive because the healthy people who would push the price down by not making claims are disincentivized to join that policy because they're going to look at it as too expensive and not worth the risk of paying all that money. So you're either looking at a positive cycle of healthy people pushing the price down because they don't make claims, or unhealthy people who on odds are going to push the price up because they make a higher amount of claims relative to the amount of people in the policy. And as that price goes up, it makes the healthy people not want to join. So these are some of the economics we're working with insurance. And as you can see, this is why it works. This is why the state usually tells you have to buy car insurance. Because if it didn't, then only the most reckless people that keep getting into accidents and only the people that really had a large amount of disposable income would be purchasing these policies because they would be even more expensive than they already are. And this would mean that they would be pushed into a negative spiral like we've just been discussing. So charity doesn't really work that well when it comes to insurance. It tends to just function like giving money away with extra steps, and it just drags down other people with it. You'd do better by just giving money directly to the people who need the healthcare. I hope that makes sense. So we're looking at the ratios of healthy to sick in summary. And in a good insurance policy, you want the highest ratio of healthy people to sick people. And a policy like that is going to be able to be the cheapest policy on the market. And this will mean that because it's the cheapest policy on the market, more people will sign up. Because it's a good price. So this leads us into the next topic. Further into the pitfalls of charity, we're looking at, in countries that are not developed here, the flip side of it, that the money goes to the most connected to the infrastructure that allows receipt of the money, which is another way of saying that those who tend to be in the most corrupt and distant positions from the people who need support the most tend to be the ones who get the money. And even if they're not corrupt, it's the most corruptible position to be in. And it's also just a very far away position. So even if they were complete angels, they had all the good intentions in the world, when you give money to the people in the cities of a very poor country, it's very hard for those resources to get out to the rural places. And so this perpetuates lots of abuses in regimes, because we might donate to charities and we don't realize that through the money that we give, that props up their operations. And this is because it's the infrastructure rails of the regime that is most able to receive the money through donations in the first place. So we need resources to reach people where they are. And this is the purpose of this lecture, is that we can use new technology to leverage this. And we can also use this to protect culture. It's not just a matter of stolen resources through very unethical working conditions. We're dealing with things like international loan sharks, like the International Monetary Fund, the IMF, who give big loans to countries, to nations that they know they can never pay back and that the people have no say in. And so more and more of the resources and the ownership of this land is taken on by people who don't even live in the country, or it's used to prop up regimes that have an unusually high amount of resources relative to everyone else, because they're working with international interests to help them strip mine the local resources or various things like that. So I know this is a big transition from talking about insurance, but what's relevant here is we're talking about helping people through the mechanism of insurance. And so when money is used and it funds tyrants who use violence to keep people subjugated, it makes it harder for them to get insurance. So our conversation up until now has been focused in the developed world. We're taking into the undeveloped world. And when the rural are kept poor because no money is spent on infrastructure for them, cities become unstable, and we have regimes that are kept in power by foreign money. And if the resources are available, they're mined, and the profits are never seen by the people. This couldn't be further from the situation we need to be in. So this is where the humanitarian element comes in, that I mentioned earlier. Who would be interested in this? Humanitarians. So when we look at things like the Norwegian model, where the oil profits of the nation go to public investment funds that benefit the public, we need to reproduce these kinds of things in nations that have vast amounts of resources that are actually, ironically, used not to make the people prosper, but used to be the means to subjugate them. These people would be better off if they had no resources. That's the horrible truth of it. When they have resources, they've become a target. So we need to promote sustainable, long-term decision-making. And we need to not just randomly send money over to these countries and send clothes over to these countries, destroy their economies, destroy their textile industries. So this takes us to the blockchain side of things. So when we look at the actual architecture of a blockchain network, we're thinking, well, how is this different? How can this help to solve these kinds of problems? So we're looking at three very rudimentary types of networks here. And the most common one we're going to be familiar with is a centralized network. This is where you have one big data center in the middle, and you have lots of recipients or communicators with that data center, but all of the thinking is done in one central location. When you look at things like distributed and decentralized networks, it looks a bit different. We see that the yellow is getting spread around a bit. And so all devices on this network run the same program. And this coordinates different machines all over the world rather than it being in one or a few data centers that are owned by one company. So if any of you have ever used LimeWire or any other torrenting or file sharing program, it's really similar to that. It basically is this. It's a distributed network. You're sharing files with people directly. And so everyone is in control of their own file sharing station when they launch this software. And so we're just adding on more complex rules. Instead of it just being sharing files, we're doing a bit more processing, and we're using a bit more of the modern technology we have access to compute some more advanced stuff, but it works in a very similar way. So decentralized and distributed networks are not so foreign to us. They just look a bit different. And they're just being used for things that we've never used them for in the past, but they're not new. They're actually quite old. And so big centralized data centers owned by big tech companies, what could possibly go wrong with this?
It's the battle between water conservation and growing Arizona's economy. Massive data centers are starting to make the valley their home. They bring a major boost to the state, but they're also using millions of gallons of water every day.
Yeah, for Impact Earth, ABC 15's Cameron Pullum is digging deeper as some local leaders are now starting to push back on this industry.
And this recent one is one that's on 396 acres. Is going to be divided into 3 phases.
City of Mesa Vice Mayor Jen Duff, the only city council member to vote no on a recently approved $800 million data center rumored to be for Facebook. Doing so after discovering the facility would eventually use 1.75 million gallons of water every day for cooling its rows of servers once fully operational. This as state reservoirs like Lake Mead and rivers like the Colorado are so low that federal restrictions are likely to be triggered on Arizona's water allocation as early as next year.
So when I think about that, and I think about the huge impact of a data center that uses water for cooling, is something I felt wasn't a good use of water for our city.
It's the 8th data center approved by the city of Mesa. She says while they do generate millions in state taxes and fees for water and electricity, the newest facility, like many others, will only employ around 150 people.
They're not high income and they don't employ a lot of people for sure.
If you want to bring in new businesses and industries that are going to be water use intensive, that should be more heavily scrutinized.
Dr. Christopher Castro, professor of hydrology and atmospheric sciences at U of A, agrees with Duff's apprehension.
So my question to them is, well, where exactly is this water coming from? Is it sustainable? Are you accounting for our current conditions of being in a long-term 20-year mega drought?
Right now, that water source would be drawing from the same ones soon to be getting cuts. That's not to say companies running these data centers aren't trying to reduce their water footprint. Some use air conditioning systems, while others are experimenting with using methods like free air cooling, which uses fresh outdoor air to cool a space. However, it only works in cooler climates.
If you want to talk about things like maybe using reclaimed or recycled water, treated wastewater, then those perhaps are more viable solutions.
As of now, that's not the case with this latest approval. Once completed, this one facility will use the same amount of water on a daily basis as 9,200 homes, something Vice Mayor Duff just couldn't ignore.
If we weren't in this cutback already, it might be different, but we are in a danger zone, in my opinion.
I'm Cameron Pullum, ABC 15, Arizona.
Yeah, so pretty concerning stuff. One of the audience members brought up a great point. Why do they always put them in the desert? In the arid regions? I don't know. But 96,000 homes is the estimate of what it uses. And we are using these services. I'm using this right now. So we are part of the problem, but we also have to acknowledge that there is a problem to begin with. And a lot of people are not aware. It doesn't take very long to look here, there, and you find things that are completely unsustainable. So we're looking at big centralized data centers, as I said, owned by tech companies, getting larger. Meanwhile, all of our devices, our smartphone, tablets, laptops, they're all getting smaller. We're even looking at wearable tech next, even putting tech inside of our brains. So everything's getting smaller except the data centers. Now, you could say the data centers are taking the bulk of the processing in order to push forward a decrease in the size of our technology. But when we look at how much market share these companies take up, in a few decades, we might just look back at these as monstrous relics of the past, in the same way we look at the old computers that we ran tape into, we ran punch cards into to operate huge computers. These data centers are looking, I think, a lot like that in 20 years' time, quite likely. Especially when we look at the fact that the cloud usage is concentrated among really just a few companies. We're looking at Amazon, Cloudflare, Google, and Microsoft. And once you get outside of those top companies, really it's hard to find meaningful competition. So we're also placing the brains of our operation, basically, in the hands of increasingly fewer and fewer administrative conglomerates, we could say. So maybe more importantly, when it comes to data centers, when we use them, either directly or indirectly, we have no say in how our data is managed and what we can do with it. We can't build real feedback loops for culture when we use company infrastructures that can and do change on a whim all the time. We have to operate under their rules, their terms of service, their policies. And not only that, but we are never assured sovereignty or any kind of ownership of our data when using these. They're out of our control, and they're owned by the big companies, as you can see on this pie graph, this pie chart. And so for systems that hold crucial data, we need a better way. So as I'll be discussing as we get further in, old problems require modern solutions, and modern solutions require data. So it's crucial that we consider that the bedrock of what takes sovereignty and freedoms away from us is also itself a financial overhead that must take its cut to self-sustain. And I'll make the argument during this first lecture that we can do away with the middlemen and run our own technology, and that it will be cheaper and more just. So one tangible solution is blockchain networking. So how does blockchain work? Let's look at kind of a step-by-step view here. Well, they run on small PCs, and sometimes they can even run on smartphones. And so a user requests a transaction, and this creates a block. It's a record of the transaction. It's a bit like sending a package in the mail. And this is sent out to all the nodes in the network. And they validate this transaction. And then that block, once it's been validated by many different, what would be called validators in the network, is added to the chain. And once it's added to the chain, it doesn't change. It stays there, and it gets verified, and it gets completed. And so if we think of basic things like sending money, that's really useful. But we can do a lot more complicated things on some of these blockchains than just sending money. We can run custom programs. We can set up conditional rules that activate based on certain things that happen. So then we start getting into what is a very interesting idea, which is, what if we could start using these blocks as sort of real-world agents that are responding to things happening. And blockchain is a bit more environmentally friendly, so it's not going to be using up the local water supply of Arizona, because it's not going to be in one big data center. And even if it starts in one big data center, the way the technology works allows it always to go back up and down in the level of centralization that it has. There's a flexibility there. And so this will become especially relevant in the third lecture, where we talk about cybernetics and look at money for robots. But here and now, we're concerned with the fact that smart contracts are highly powerful and configurable blank slates. And we can fill them with code that runs according to the rules and conditions that we want. This is why they're called immutable. It's a fancy way of saying they ain't changing on a whim, because they are written to the blockchain ledger, they stay there, and they can't be modified outside of their already established, quite literal, code of conduct. Which is funny because corporations talk all the time about their codes of conduct and then turn their back on them. Imagine building around an actual foundational product that has to adhere to the conduct of its code. So you could think of this a bit like a toy train, or even a real functional train on a track. It can be knocked off when things go wrong, but most of the time it follows a pre-established path that we build for it over and over again as expected. And so I mentioned feedback loops for robots, but we also have to consider feedback loops for ourselves. The implications of relying on company infrastructures for foundationally compromised cultural feedback loops leads to us losing steady foundation year after year, because if our world is going to continue to be reimagined using data, then those in control of where that data is stored, run, and how it can be used are also placing us at their feet in terms of the whims of it continuing to be there. And if you've ever been an enjoyer of an online game whose host decided to shutter the multiplayer servers, or enjoyed a product or service that is no longer available, and the company has arbitrarily decided to cease support for it in favor of a new product or service that is in all ways worse, then in a small way you will know why we can't place even our entertainment in the hands of subscription services and data centers out of our control. We certainly shouldn't be doing it with the tools of our economies and personal lives. If our lives are being controlled by data, then our data becomes an extension of ourselves. Change to our data causes change in our lives. And we can't just let companies have this level of influence, companies that can and do change on a whim. And not only that, but we are never assured sovereignty or any kind of ownership over our data when using these services. They are out of our control and owned by the big companies, IBM, Amazon, Google, Microsoft. So without belaboring the point, old problems require the modern solutions. And modern solutions require the data, and the further we go down this path, the less we can rely on centralized systems of trust. We simply can't afford to. For systems that hold crucial data, we need a better way. We need to build our own rails. And consider this. What erodes sovereignty away is always an administrative overhead that must take its cut to self-sustain. So when we look at blockchain, which is a way of doing things where payments don't need to use cash sent via the mail, unreliable banks, or payment services that take huge cuts, it can be immediately distributed algorithmically to those holding the policies in full. And this could be to Western Union, a cell phone voucher system like M-Pesa, something that's popular in Kenya. It could be affiliated distributors, allowing new careers within the communities. The key is that we don't have to rely on any one method, because each have their advantages and disadvantages. What matters most is that we make sure the money gets to the people who need it as fast as possible and as whole as possible, and that our rails are resilient for everyone. This could mean the difference between at best recovering after a disaster to catch your farming season, or at worst being able to at least afford to put food on the table because you've been given money to buy some other food and import it in, and you can pick up the next season. And in developed economies, This offers a real protection against identity theft, which is only going to become a bigger and a bigger problem. And when we insure labor, things like farm work, we can use no claims to generate real excess value year over year that protects the farmer or small business owner against the local devaluation of their currencies. So this protection of wealth that's tied to the very real things that they do allows saving. And this allows the basis for them to get loans. And with loans, they can use the no claims that get rolled over to next year to borrow against that and buy tools to make their farming safer, higher yield, and more reliable. And this can be facilitated by non-governmental organizations or businesses if it's not fully adopted in the local area to use these digital networks to pay for things. But most importantly, this facilitates the rise of the secondary industry through the purchase of things like irrigation services, because a lot of these farmers don't use irrigation. And so we can get increased resilience through tools. They decrease our risk to insure. And this creates a positive feedback loop, because we were talking earlier about how the people that begin to need insurance less allow them to push the price down. And so we'll look at that happen as they get more resources. This makes them safer to insure, and this pushes their prices down and their profits up. And so this creates excess production. And this is money that can be reinvested in their local communities or growing their businesses further. And this works a lot better than just giving them money, because it doesn't just go to the tyrants, it goes directly to the people doing the work, because it's tied, the money is tied to their labor. And so the family poverty trap becomes the community breadbasket. But not just that, their food security improves the food security of the whole world. And so when we can use digital methods that immediately distribute to them algorithmically, to the people that hold the policies, we can allow them to save a lot of time, which also increases not only their security, but the food security of the world as well. So promoting this is what crowdsurance.org is all about, helping get the poor, vulnerable, the insurance and financial services they need, getting them out of poverty traps that can sometimes be multi-generational, and to help insurance engineers build and deploy what enables that to happen, helping them spread the word about their work, find talent, gain and share perspective with other engineers in the space, and also map the people that are in the space so that new people and institutions coming into it are able to get informed who's working on what, where, what are the results, and what are the backgrounds of the different teams and projects. And these will be invaluable to those looking to make informed investments and donations, as well as allowing those with a lot of wisdom in insurance to come in and help people who maybe have less experience or less range of experience to make services and algorithms that actually work really well. By them having the information to come in, they'll be able to make an informed decision about why they're there. And they'll also be able to justify, whether it's an employee justifying to their higher-ups, or it's the company's PR team justifying why they got involved in a certain project. They'll really be able to pitch it to themselves and to the world what it's all about. And so they can do this on their social media, and they can justify the financial or the human resources they've allocated to these initiatives, which is really important in corporations. You have to be able to justify everything you're doing. And with the information collated into a good place, this will give them a really good resource to help do that. And that's something that Crowdsurance wants to help with. So we're looking at people that have no insurance here. Things that get them into debt traps. So we talked about intergenerational poverty. So when something bad happens, You pay the full price, you go into debt, and then you cry about it. That's what happens if you don't have insurance, especially if you're a farmer in rural Kenya or something. You're screwed, is a polite way of putting it. So we don't want that. So in developed nations, maybe like the UK, USA, Australia, Singapore, it's not going to matter as much. But with greater safety and wealth often comes strict regulations. We've got more rules. We've got doing business being more expensive because of the government and the oversight agencies that are getting involved. And we've got a highly competitive and bloated market share. Everybody's in the space. Everybody's filled it out. It's full of big companies. And in this environment, economies of scale, which basically just means you get big and you can do things in a large way, they get not just rewarded, but they're basically essential. But now this creates a lot of cost. And this isn't so much of a problem in the advanced economies, because even if the competition of a cheaper way of doing it could come in, there's too many social and legal obstacles and competition against these new technologies. And this would be competition against the corporate market shares and the entrenched interests. So there would be collusion between the governments and the corporations to keep this competition out. And they would use red tape and probably smear campaigns as the basis to do it. So the place to push this technology is not in the developed economies. And we're looking at places, when we say developed countries, that are safer, lower crime. They come with a lot of rules, but there's more consistency in the rules. So who is succeeding in these spaces? Well, we have InsurTech, which is centralized, but with new technology. So it's doing great in developed nations because it's still working under the expectations of what insurance is sort of meant to look like. But it's pushing the envelope a bit in terms of regulatory rules. And it's making them accommodate some new innovations here and there, but it's having to fight a lot to get that. So it might pave the ground layers for distributed insurance models one day. But for now, these are registered business entities and offices, and they function as traditional, legitimate businesses that use established structures that established economies like. So it's nothing like decentralized blockchain technology at all. Now, what about this? Well, it's certainly not going to have big regulatory and government apparatus that would make doing anything illegal. It's really not going to have any corporations to compete against. Really, it doesn't have anything. It's a wide open space. So when we think about how we could get insurance to people who live in places like this, that's where it gets interesting. So we can strongly place the scope of this new technology in areas of the world where there is little to no competition, because no one has been able to meet insurance needs, and the governing bodies, charities, and assorted interest groups in these areas are not hostile. They're actually desperate for someone, anyone, that can come in and help. And since the core of the issue for a long time has been that insurance is too expensive to operate, it's prone to centralized vulnerabilities that make it a target, such as storing data in central places, and it has little to no accountability to that data. So we have sums of money sitting around to pay claims that are like a honeypot. So when trying to do business in the traditional way, it makes an internal incentive for corruption, because there's money to be made by changing policies retroactively, which is committing fraud. And there's external incentives for any local regime to demand protection money, or outright steal company resources, or to attack the business because it is perceived to have cooperated with the previous regime, even though this was non-optional. So prior to when a new power comes in, during those power vacuums, there might be looting and rioting, which can also affect the business. And this places the policyholders at risk of not getting the money they're entitled to when they need it most, if they can even get the policy in the first place. And it places any employees in the office in the position of being sitting ducks for being targets of ransom, extortion, as well as demands for them to modify policies to meet the demands of powerful interest groups in the local area. It might be the case that a business that wants to bankrupt farmers so they can buy them out might first try and weaken any limited structures or supports that the other businesses have around them. And the biggest problem of all is that traditional centralized insurance administered from company offices is simply too expensive to run. It means that millions, if not billions worldwide, cannot afford insurance access. The price of entry is just too high. The problem in poor countries, I'm going to sum up as 4 main issues. 1 is the differential, preferential, and inconsistent enforcement of rules and regulations. 2, violence, regime changes, and a lack of private property. 3, a lack of remedial recourse, legally or otherwise. When things go wrong, you have no mechanism to put things right. And last but not least, we have poor or completely lacking in non-existent infrastructure. Inconsistent roads, huge earning disparities between the cities and the rural locations, and all of this makes coverage outside of cities expensive, sometimes too expensive. We want the idea of permaculture when it comes to growing food and gardens, rather than these industrial methods of completely destroying all of the nutrients in the soil. We're seeing that applied just whole cloth across the general business sector in a lot of the developed economies. And this is a real movement away from that.
84% of the world's 570 million farmers are smallholder farmers. And the definition of a smallholder farmer is a farmer who is plotting on less than 2 hectares of land. And so for those of you who don't know what a hectare is, like I didn't before I joined Pula, it's a 100 meters by 100 meters box is basically 1 hectare. And so if it's 2 hectares or below, then you're considered a smallholder farmer. And smallholder farmers as a collective entity produce 35% of the world's food source. And so another sort of a fact point I'd like to share is that, as we have heard from some of the other speakers, is that smallholder farmers are some of the poorest people on the planet. And tragically and somewhat ironically, they're also one of the most vulnerable to food security. So you would think that if you're actually involved in food production, then you would have better access to food. But actually, paradoxically, they are more likely to go hungry than other segments of society.
So from a regulatory point of view, just to maybe share a little bit of how regulators see inclusive insurance. Maybe we talked a little bit early in the morning today about microinsurance, inclusive insurance, but basically from a regulatory point of view, it's about insurance that's accessed by people who are in the low-income population. But also in some other jurisdictions or some other countries, it's also about insurance products that are for people who don't have access to insurance for whatever reason. For example, cancer patients who can't get travel insurance. So it really depends on the country, but in any country, you will always find a group of people who can't access insurance because, as you know, insurance penetration rates are very low. And right, so in a lot of emerging markets especially, what do the excluded look like? We also heard a lot of very interesting stories this morning already. So, you know, it's really the 90% of people or employed people in Ghana who are informally employed. It's the 80% of Moroccans who are unemployed, who are youths or 65 and older, what they call housewives, low-income households, farmers, micro-enterprises. It's the 90% of the poorest rural and urban Indians. So it's not about just rural people, rural and urban Indians with no health insurance and who have to use up their savings, who have to borrow from people, or who have to delay healthcare in order to have a better quality of life, right? And these are all target groups that were articulated by their own governments themselves. So this is how they see inclusive insurance.
Yeah, so the producers of the food have the least access to it. How many of us knew that? So we see it's not only important for the benefit of them, but if the whole world is buying the food from them, it's important for us as well. And since they produce such a large share of the world food supply, their resilience is our resilience. I really want to stress that point, that we're getting about a quarter of our, by estimates, about a quarter of our world's food supply from people who are living the equivalent of paycheck to paycheck, but with no money. And so we're a lot more connected than we might think. And the good news is that we are not alone in our concerns for these groups, because as much as there can be violent regimes, abusive leaders, there's also a lot of countries that are not like that. There's also, even in those difficult places, a lot of support for these initiatives. So there are those who see the problem, and they want to try and fix the problem. And we can leverage in these developed economies our ability to develop and strategize and implement different technologies, use our resources to go over there and consult and help build tools that function a lot like the old adage that you don't just give a man a fish, but you teach a man how to fish. And so this kind of paints a portrait of the people who need help the most. So if anyone wants to go on a quick break, I have to clear some file space. So I'm just going to take a quick break. This is a really good stopping point. Is everyone digitally seated or something? All right, perfect. So where did we leave off? We were talking about the people in rural places that are the producers of food who go hungry. And so we have a name for these people. I have given them a name. They have many names, but there's one name that I give them: the unreachables. And with this group of people, we are looking at a couple of points of concern. Why do I call them the unreachables? Well, we're looking at rural and remote places, farms, no infrastructure. You might have dirt roads if you're lucky, so you can get there with off-road vehicles. These people are low income, so they live season to season, and they make their money on relying on a good crop. And they don't really have many ways to save outside of the wealth that they have in seeds and in the wealth they can generate from getting a good yield that season. We're dealing with people that are unbanked, and they just don't have access to financial services. And even if they were banked, the local currencies that they would have access to are usually quite unstable, not very suitable for long-term saving. These people, because they lack irrigation, tend to be very vulnerable to even subtle changes in weather systems, which has been happening in recent times. A lot of the speakers from the decentralized conference in 2022 that I was showing two excerpts from. The first was Elise Lee from Pula on presentation 3, and the second one was, I believe, presentation 13 by Huilin Xu. And across the board, many of the speakers on that presentation, including Elise Lee, talked about the disruptions to the natural weather patterns that they have been relying on and has been passed down to them through generational wisdom, a bit like the knowledge of the trade winds going back to the maritime industry. And I've heard that that has been in some ways changing in some small ways as well. So we have weather changes, and these are affecting the ways of life that these people have built themselves around, and it's having some disastrous consequences. So there's an argument that it really is not just a great time, but an essential time to get these people insured, not just for their benefit, but as we've already discussed, because they're producing the necessity of life, or one of them, which is food, and they are supplying the world with food. So their protection is our protection. Their resilience is our resilience. And speaking of their resilience, these people tend to have no health care. So small illnesses can become life-changing. Small sicknesses, diseases that are in our nations with our technology easily preventable, to people who don't have antiseptic treatments, they don't have antibiotics, they don't have maybe even basic medical implements or the training or knowledge of how to do some of these things. They can go downhill very quickly. And so these people have no path to retirement. And so if they are forced into an early retirement, this could put their entire family at risk of poverty. And so these people, through no fault of their own, are often trapped within these issues. They're trapped within the changes to their regime, whether it's violent or non-violent. There is uncertainty, and this destroys the confidence that they have to be able to plan further than a season ahead. And when they don't have access to healthcare, insurance, or irrigation, they can easily be trapped in endless generational cycles of poverty. And if you look this up, you will find no shortage of videos that tell these stories. This is a story that has well been told, so I'm not going to go into this, but trust that if we can reach them through text message, through their seed dealers, through charitable outreach organizations, religious ministries, even carrier pigeons, we can make a difference. And furthermore, the extent that any regimes they live with keep them down, to the extent that they are violent and brutal, the regimes will lack the sophistication to understand the complex technology and methods being used. So we might not outgun them, but we will outsmart them in the end, as the power from bottom up will grow, as if it is the small tree with huge roots beneath the ground that have planted themselves before we see it grow into a large natural phenomenon, a powerhouse. And with all its strength of a huge oak, this will come with time. So we're looking at something that's a bit like a silent revolution. What will be beneath the surface will not be perceived until it's too late for the people who want to subjugate them. And the people who've now grown that hidden wealth under the ground will have new options. And so the people that run these brutal regimes, quite frankly, they're too greedy to think long term, and they're too brutal to understand. And if they weren't too brutal to understand, they wouldn't be brutal to begin with. So we can outsmart them. And so this leads us into the truism that this is an old problem, that insurance can't reach these people. And so it has led to a reliance on charity. And this is inconsistent. And this destroys their local industries, whether it's food production, whether it's, textiles industries, destroying their clothes production. It wreaks havoc on their economies. it causes big gluts of supplies and big dearths of supplies, and there is no consistent basis that they can build themselves up when they're being given free things on the one hand and then having things stolen from them on the other hand, whether it's by natural causes or from their governments. So we clearly have an obstacle here that we need to get charity out. We need to stop giving them the fish, and we need to start giving them the tools that they need to build it on their own. And this may sound harsh. It may sound easy for us in a more comfortable position to have, let alone strong opinions, but any opinion about what these people should do. But the truth is, for them to get out of their situation, in my opinion, we need to give them the tools and have them build those strong, resilient foundations by using the tools themselves. And we can give them guidance, we can give them help, we can give them all the support we possibly can, but we just can't give because it's not sustainable. Everything in this presentation so far, from the data centers using up all the resources, to the increasing centralization of how our data is used, to the ethical dilemmas of building insurance and trying to make a profit from it, all of these bring in questions of what is sustainable. And we live in a modern situation where a lot of what is called planned obsolescence is taking shape. This is the throwaway culture. This is the new iPhone every year. This is the fast clothing with cheap threading that is being thrown away into landfills whilst being created by people who are paid barely a living wage, if one at all. And so we're in a culture that throws away things we take for granted, whilst other people can't even live off of the work they do to provide us the things we throw away. And so wherever we look at things being polluted, things becoming more and more unsustainable. And as they become this way, they start to lose control and they start to become unstable as well. So all of this isn't just theory. This leads to actual costs. So we ask, why can't we reach these people? Well, one of the biggest reasons is that insurance is expensive. We're dealing with rent, utilities to buy an office. We're dealing with the legal burdens of compliance. We might have protection money that the local groups, the local governments are demanding that we pay. We have the employees. We have theft and extortion. We have the need to actually, even if you're an insurance company, to insure your own building. A lot of people forget that. Just because you're an insurance company doesn't mean you don't need insurance. And we're dealing with a lot of violence and corruption as well. So these are expenses that also mingle into larger questions of safety, security, and ethics that we've kind of been dancing around. So let's get specifically into it right now. So it's not just a problem that when you run a company and you need to pay for all these things, that pushes your cost base up and makes you unable to cover people who make less money than what it would basically cost you to administrate the policy. Let me say that again. When you go into somewhere like Uganda or Kenya or some rural part of Eastern Europe or some part of Asia, maybe some rural part of Vietnam or something like that, you're going to set up an office, and that office is going to cost you more money than it would generate from being able to cover people. So you would pay more just to keep the lights on than anyone you could claim who needs insurance the most would even be able to pay you. You can't even get started like that. And also, we have safety issues. So we're dealing with threats to employees. Things like gangs, regime changes, protection racketeering, investigation, and all kinds of issues that have to do with the safety of employees. They are sat in a central building in an unstable country filled with sometimes armed goons and regimes that change all the time. The history of AIG, from the AIG story, has some interesting stories about this. When they were establishing offices in some of these places, they did experience some of these things. These aren't just theoretical, they have actually happened to companies operating in some of these more unstable, more politically volatile countries. A lot is on the table that we don't think of when we think of building a company in the UK, in America, or in Singapore. So we don't just have threats to employees, which are bad enough. We have threats to the fundamental business itself, which is the policies. So we have fraudulent document changes. If you have papers in an office, whether it's physical or it's digital, someone could come and change them at any time. You may ask, what's the problem with that? Well, if they change it at any time, then they could commit fraud and deny people money they're owed. You could deal with irresponsible underwriting. So general lack of quality control. You could deal with unstable governments. You could deal with skimming profits. And you could deal with theft and destruction of documents. Whether it's a random fire or it is the stealing of different documents so that they can avoid paying. If you're a paying customer who is owed a policy and those documents go missing, there's no proof you actually had that. It can be denied. So we're dealing with the ability to get out of helping people when they need it most. So these can have real consequences. And the last but not least, we have a central place that becomes a target of bribery and corruption. And the thing about this is it always starts small. A favor for somebody, oh, could you tweak this little bit in the policy? Could you change that stipulation here and there? And before you know it, you're making widespread changes to tons of documents that affect, on a large scale, who gets paid out and who doesn't. Let's say you collude because you're aware that the local Gestapo, or Gestapo, however you say it, the local goon squad, is planning on raiding some business. For whatever reason. They come to you and they say, hey, if we give you advance notice, you can change that policy around and you'll save a bunch of money and just give us a bit of a cut. This kind of stuff happens as well. So maybe even one of the local goon squad insists with a lot of force that their incompetent and corrupt son is on your board of directors. You simply can't say no, and you have to turn a blind eye to somebody who is now sitting on your company board embezzling funds. These are completely backwards situations, but they happen all the time. So insurance in the third world, in developing countries, in the completely stagnant countries, in the volatile countries, whatever you want to call them, it can be a dirty business. But that's not really insurance's fault. That's because any business over there becomes a dirty business. I have a video to play.
While we are here, the parametric insurance on blockchain. Now, we've solved the problem of distribution. Now, we needed to solve the problem of claims. Now, ECA is not an insurance company, so it cannot pay claims. It needs to work with an insurance company. The bureaucracy in the traditional insurance companies now is starting to creep in. Now, how do you solve it? We introduce a technology that helps, one, in transparency. You see, I don't say insurance companies can do this or do this. If at times the trigger means will cause the company to pay a lot of claims, somebody who is not good might decide to change the triggers. The triggers used during onboarding are not the same ones used during the payout. How would we know? It's a black box. Nobody knows. In fact, one of the problems was the flow of information down to the farmers. Now, to solve this, blockchain. So we're able to get weather information, we're able to notarize the triggers and automatically generate payout schedules, because there's this engine. Let me show you how it works. So once the farmer is onboarded on one side, the customer data comes in a contract review engine. Contract review engine brings together weather data, farmer data, which is their location, the amount they paid, and also brings in the actuarial formulas. So using the calculation at this point, they're able to produce a list of people who should be paid or not, which is very accurate, which is now a list that can be trusted because it's being done using a smart contract and on the blockchain.
So that gives you a bit of an idea of how it can work. And as Benson Yuguna from that presentation, from the same D1Conf 2022, as he was talking about, we don't know in the traditional insurance company who has changed what. But we have the issue that at any time it could be changed. Now, for the longest time, that's just been something we've had to accept as a result of doing business in these countries. But it is the new technology that has come about very recently, really in the last decade maybe, that is allowing us to think of a different way of going about this. So it's not something that no one has ever thought of before as a problem. It's more that no one has ever had a tangible way to solve the problem. And what blockchain technology allows us to do is have a very, very promising way that we can go about trying to solve this problem, which is a big problem. And some of the early work that people like Benson Yuguna are doing with Acre Africa and like Elise Lee are doing with Pula are involved on the ground working with these vulnerable groups and vulnerable individuals, and they have actually made payouts so far. So there's some other things we can think about as well. We have to think about the nature of identity. So when you live somewhere very rural, it's hard to establish yourself as a business identity. Really, you are just an individual doing hard labor, and you may or may not succeed. But the difference between success and failure is more on the side of whether you fail a lot or you can just about get by. So what becomes interesting is when we think about how these people have not just an issue with savings, not just an issue with food scarcity, but they also have an issue with identity. How do we make sure that they are who they say they are? They're probably not going to have official documents. And even if they did, we're talking about documents from the same offices that have the very same flaws that we've just been talking about with insurance companies. So that isn't a workable solution. So not only do we need to be able to verify the work they're doing, we need to actually be able to attach that to an identity that they can have. And this will kind of form a new kind of business entity. It will just be on the blockchain. And it'll be like a dossier of all the activities of the business. Just like someone's medical report, you will be able to look through all of what they've done, all the policies they've taken out, the amount of claims they've made. And this is, in a sense, a bit like a credit score as well. So now we have the basis of actually attaching real-world labor to real individuals and families and using those as the basis of identity on blockchain to allow them to take things like loans out, not anonymously, but attached to these real identities. So it's kind of allowing the establishment, when we get these side benefits of having an internationally compatible personal and business entity that forms the basis of a cultural revolution. Because when the unreachables are able to start leveraging legitimate business identities, this is where they can have verifiable work histories. And they can also hire employees who can receive insurance underneath a company in a structure like this. And we can use various things like what would be called zero-knowledge proofs that would help us obscure information that might be private, but allow it to exist in an encrypted manner during the creation of a contract and then get rid of it. We can have things like private keys that allow us to unlock certain data. So it's not a flawless system. We don't want to create a dynamic where we have the names and addresses of everybody laid out on a platter so that the local regime can slowly round them up and steal from them. We want to avoid that. But we do have to take some opportunities and improve them as we go. And so for the use cases where privacy is absolutely essential, that can be worked on. And that's just an extra layer that is necessary in the process of them getting the coverage they need, because it goes beyond insurance, which forms the basis of them being able to be considered a safe and legitimate business. And once considered a safe and legitimate business, they can then go on to take out things like loans, operate from an official business identity, and have an internationally recognizable structure that they can take on employees with. And this allows them to actually grow and negotiate as well. So, let's recap. When we have a central location, the issues we're facing are harassment, protection racketeering, we're dealing with kidnapping of employees or ransom. This could even be for grudges. It doesn't even have to be for profit. We can deal with theft of the reserves of cash and the tools and computers. And we can deal with the loss of policy documents. We can deal with corruption. Changing things is what Benson was talking about with the black box. We can be changing the documents. And this can mean that we're dealing with theft, modification, or destruction. So the centralized office opens us up from the business side and from the individual side to a lot of dangers. And this means everyone is vulnerable, whether it's the employees, the business owners, or the people signing up for the policies, if they can even afford to be covered in the first place. So when we're dealing with the rural, it has to be immutable, which, as we already discussed, means it's not going to be changed, which means it's corruption and regime resistant. There is no central office anymore. We're taking cost out of the picture now, theoretically. If we take cost out, there exist 3 problem areas still. One is sending money to claimants, the people that own the policies. We have to get the money to them and get them funded. 2, we're dealing with the theft of money along the way. Is it getting lost or damaged? And 3, the modification of policy documents that govern the money the vulnerable people are entitled to. So blockchain solves these because it allows the distribution of the money very efficiently, and it allows the unchangeability of the documents. But in order to deliver this, we have to do what would be not even 10 years ago, and probably still even to now, today would be considered a completely ludicrous and unworkable approach, and we have to prove them wrong. The elimination of the office. The office has to go. This means an end to the desk jockey in a traditional sense. And remote and hybrid work was growing anyway, and especially during and after lockdowns, sorry to remind you of that. But with no office, files are no longer there to be stolen or tampered with. There's no building to raid, there's no employees to harass, bribe, or take hostage. Policies are impossible to change retroactively. And now the insurance policy process is not opaque, but instead it's auditable and it's verifiably sound. And we can prove that people are getting what they've paid for. And also it becomes affordable, so they can pay for it. And it's able to reach almost anyone in the world. And the best part is that when we build structures like this, office meetups are still possible. There's cafes, there's co-working spaces. So information and labor will be distributed on the blockchain or on co-working cloud systems and various other mechanisms before it reaches that, but it will happen in a more decentralized way, a more distributed way, and be attached to a process that is cheaper, easier to audit, verify, and avoid corruption within. And so with blockchain, payments don't need to use cash sent via the mail. They don't need to use unreliable banks or payment services that take huge cuts. We can instead use native methods that are immediately distributed algorithmically to those holding the policies in full, allowing them to save a lot of time. And that would mean the difference between, at best, recovering from the disaster to catch the farming season as it's still going, or at worst, at least being able to afford to put food on the table until the next one. So with blockchain, the key is that we don't have to rely on any one method. We could use Western Union. We could use the cell phone voucher system like M-Pesa, as that's popular in Kenya, like Benson, who's from Kenya, mentioned. We could use affiliated distributors, allowing sales careers within communities to form, allowing seed dealers to take cuts and make affiliate profits. The key is we don't have to rely on any one method because each has its advantages and disadvantages. What matters most is that we need to make sure the money gets to the people who need it as fast and as whole as possible. And so when we also have the accrual of no claims, when things go well, right, which as we were talking about earlier, the best insurance policies are the ones that don't get claimed on. But in the traditional capacity, right, we have an insurance policy that is run for profit as part of a larger business that has many policies. So we're doing underwriting for profit. What that means is the interests of the corporation usually are at odds with the interest of the person buying the insurance. And this is why we get adverse selection. This is why we have to have the office on top of 5 flights of stairs, because there is a corporate structure that exists that needs to not only maximize profits, but make sure there's some profit to begin with. So, okay, with blockchain, we can pass the administrative buck over to algorithms. Whether that's algorithms using weather sensor data like satellites and other information that's fed through oracles like Chainlink into the smart contract that allows that contract to run on its preconditionally created track and make those decisions justly. Or we have a voting system where the people who show up are rewarded if they make the majority decision, and the people that make the minority decision on whether a claim is paid out or not paid out are punished. That's another way of doing it, because of course, if the majority are assumed to be right, then if you're in the minority, you might be scheming. So we have lots of opportunities when we lower the cost base, when we're taking out the utilities, when we're taking out the need to insure an office, when we're taking out the need to house employees and buy them equipment that has to sit in that office, when we allow people to use the resources they already have, saving us money on all of these things, we don't have to put that into the cost of the policy. And when we're running contracts that are taking information in digitally, this is a native approach that allows a lot of machine learning technology and other intervention to occur that's a lot more efficient than humans trying to do this manually, and a lot less exposed to the human corruption that we've talked about. Of course, we can have technical corruption, we can have bugs, glitches, hacks. They're going to happen. But the point is we would have insurance for that. So in any case, there's always risks in anything. There's no perfect solution. What we're looking for is a solution that gets us past a complete brick wall that we can't cross, we can't get through. This is going to jump over that, because we are no longer held back by the things that make doing this kind of business financially impossible, as well as socially and practically unsafe. So when the business is run at cost, what we get is the ability to take away the conflict of interest that usually exists between the policy holder and the policy creator. Now, there is no need to take profit. There will just be the smallest minuscule transaction fees and maybe a sales commission fee taken out. That will be it. And both the person taking the transaction fee and the sales commission fee should by and large be completely neutral parties. Obviously, they would benefit if the claim was paid out because their customers would have the money to buy more policies from them. So they would be motivated to make sure the policies work, otherwise they would stop getting money. But that's a good thing, because that means that they're going to be motivated to actually give their customers a service and a product that actually works, because their money is going to be attached to it delivering. If it doesn't work, then the customer's going to have no money, and they won't be able to buy from them anymore. And even if they did have money, they wouldn't want to. So when we take away this, it's called running at cost. And when we run it at cost, it's no longer for profit. There's no longer a dueling incentive. We can build policies that just work. And so this leads to the last slide here. I know you've been with me for a while. I thank everyone for showing up. I had to put this presentation together really quickly to show up here, so I hope it's been okay. The last thing I want to talk about is a bit of a bigger picture idea. And this is of the horse and cart, which was an established way of doing things. Well, we don't really use the horse and cart very much anymore, but we still use the wheel. That's interesting, because the wheel outlived the cart. We use the wheel on cars. We use the wheel on airplanes. I think we even sometimes use the wheel on trains. It's just a metal wheel. So we use wheels on all kinds of things. Literal machines that fly in the air still use the wheel. And so my closing statement for this lecture is this. The core function of insurance is like the wheel, and the old centralized corporation like the horse and cart. Rather than getting fixated on whether it's new, old, or somewhere in between, as long as it brings real and positive life changes, does it even matter? It's not us versus them, focused in these new frontiers of big problems like Lloyd's of London were. It's the market share of companies that aren't going to be affected, meaning most of them will want to help because they can benefit too. These very same corporations can gain a great brand reputation by helping these causes of providing insurance to people who need it. And it's a pressure release valve for forward-thinking, innovative employees that have been agitating within the company. It gives them something to do. And this allows these corporations to learn new methods and gain new technologies to implement in their larger business, in the developed markets, that give them a greater competitive edge and allow them to improve their market share. And it promotes an internal cultural rebirth within the larger corporation. Employees see that they are supporting real causes that make a real difference, and therefore their work no longer feels quite as much like paper pushing, or as arbitrary and meaningless. So it can have a real rejuvenating effect to know that the organization that you're a part of is actually supporting real change and not just paying lip service to it. And this forms the basic case for the industry in the first of 3 lectures here. This has been the crowdsurance.org presentation for ending world poverty, ending world hunger with blockchain and insurance. I hope you enjoyed. I hope you found it interesting. Thank you for showing up. And I open the floor to any questions. Thank you.
Thank you so much, Adam. You explained everything very thoroughly and clearly. I just wanted to ask one more time. There's 2 more lectures coming up. Can you tell us a little bit about those?
Yeah, so the first lecture here was really trying to establish the basic idea of what some of the problems are, what are some of the things that have held us back, and how can we use new technology to overcome those problems. The second lecture, and this kind of follows a bit of a time, how would I describe it? It follows a bit of a timeline. The first lecture is the thing that would happen earliest on. And then the second lecture is the argument that if and when this is implemented, here's how it will evolve into a full-blown economic system that replaces the local one, which is woefully inefficient. Because we're talking about people that are unbanked, so they don't really have much other than some paper notes here and there that are going to be crumpled, torn, and attached to a currency that is extremely unreliable itself. So we're going to give them real savings and give them real financial rails they can use. And this will lead to the creation of things like trade unions and investment products and more advanced methods of saving and gaining interest. So I'll be talking about how an economic system could form from the basis of ensuring all of this labor. And in the third presentation, it will be about how robotics will relate, and things like automation and the Internet of Things will relate to these economic systems. Because when we're dealing with money for robots and an algorithmic structure that robots can integrate with, that can even inform the behavior of robots, we could deal with things like robots knowing when to insure themselves, which in the developed world could look like your car knowing when to buy insurance or not buy insurance. Or it could deal with your robots that go around picking up waste on the street, knowing which location to drop it off, and receiving direct payment to the owner of that robot that picks up that waste into its bank account. So these are real transactions that robots will do directly with other robots, or directly with businesses themselves, which is money that robots can natively interact with. And so when we look at automating things like farming, I'm going to look at the battle that's going to happen, in my opinion, between those that have the resources to automate mass farming versus those that are the poorest but produce crops very cheaply. We're going to have a battle between those who have the most resources and those who have the least, and I believe these economic mechanisms will kind of act like an evening effect that will move them closer towards each other, bringing the poor up and bringing the excesses of the throwaway automated developed economies a bit down. And this will allow them to establish and use the protection mechanisms that they've established in the second lecture to protect them from potentially having their labor and their livelihood outsourced, because they will become stakeholders or even maybe shareholders of new automated economies that will have to interact with their ecosystem in order to even function in the first place. So that's the basic idea of the next 2 lectures. They kind of all link together, and that's why it's a 3-part series, and each one becomes, I would say, a lot more speculative than the last, and each one predicts it being much more ahead of time in implementing it than the last. So lecture 1 is much closer to where we actually are right now. Lecture 2 will talk about where we might go from Lecture 1, and Lecture 3 is where we might go if we reach the end of Lecture 2. I hope that makes sense.
Thank you so much. It sounds like things are going to get pretty interesting in the next 2 lectures. I would like to open the floor for any specific questions about today's